No, I think the banking sector is very sick. It's not healthy at all. In fact, I think it has a terminal disease of government and, Fed policy. I mean, I was warning about this crisis for years, just like I warned about the 2008 financial crisis for years. I could see this thing coming from a mile away. When everybody was extolling the virtues of the 0% interest rates and the benefits that, it had for borrowers, it was great. Americans could refinance their mortgages and get these rock bottom 30-year fixed rates, at 3%. Some people even got two handles on their 30-year mortgages. The government was able to finance all this debt at lower interest rates, and that kept the debt service costs down. So everybody was benefiting from the ability to lock in long-term debt at rock bottom rates. And I was one of the only people that I know of that was out there trying to point out the negative for the lender. Because what's good for the borrower isn't also good for the lender. If the borrowers are winning by locking in low rates, the lenders are losing at the same time because they're also locked in to low rates, only they're receiving the low rates. They're not paying the low rates. And so I was warning for years, what is going to happen to the holders of this debt, in particular, the banking system, when interest rates eventually rise? And you get to a situation where now money costs 5% and the banks have locked in their portfolios at 1%, 2%, 3%. I said this was going to be a disaster for the banks. And of course, that's exactly what it was. We got the beginning of what would have been a worse financial crisis than 2008 in March of last year. And that crisis wasn't canceled, it's just been postponed. The Fed was able to hold it in abeyance by announcing a program where the Fed would temporarily take all of that underwater collateral off the books of the banks and replace it with cash, 100 cents on the dollar. The catch was it only good for a year. In theory, all those banks have to repay the Fed 100 cents on the dollar of what they borrowed, and they got to take their toxic paper back, which they obviously can't do because they would be bankrupt the minute it got back on their books, which is why they gave it to the Fed in the first place. Eventually, there's a tremendous moral hazard here because of what the government has done with these deposit guarantees. I mean, we should have no FDIC. The public should know that you put your money at a bank, you're at risk. You're a creditor, and if that bank fails, you could lose your deposits. We need that for the public to be better customers when it comes to choosing a bank. But because of the government, nobody gives a damn which bank they put their money in, because it doesn't matter. Because if the bank fails, you're going to get your money back. Well, what happened, when we had that Silicon Valley failure and Signature Bank and a few others, the government let the public know that, it's not necessarily true. Your bank might fail and, you could lose money if you have more than the FDIC covered amount. But it depends, because if the government decides that the bank that you're with is somehow systemically important, then we're going to bail everybody out. But if we don't think the bank is significant enough, then we won't. And so what that did is it created a huge competitive advantage for the big banks, like JB Diamond's bank. All these big banks, everybody knows, well, they're too big to fail. So There's no question that if I have my money with these big banks, I'm good. My deposits are going to be safe. But a lot of these smaller regional banks, kind of mom and pop banks, to the extent that they're mom and pop, but they're smaller banks, it's a question. And so why should I hold a large amount of money at a small bank when there's a risk that small bank fails and I'm not protected? So I'm going to take my money out and I'm going to give it to these bigger banks. And this gives the big banks a competitive edge in the marketplace. And so what ends up happening is the small banks go out of business or they get acquired by the bigger banks because they can't compete because it's not a level playing field. The government has tilted it. Now, of course, the government could have said, look, we're going to insure every deposit up to an unlimited amount of money. But of course, the FDIC doesn't have the resources to do that. It doesn't even have the resources to insure the deposits that are currently insured. I mean, if a major bank failed, like a Bank of America or Wells Fargo, that would wipe out the FDIC all by itself. And so, the government would have to come and bail it out. But the government is broke. So where does the government get the money? It gets it from the Fed. But the Fed doesn't have any money until it prints it. But when the Fed prints the money, that just means inflation. That means that the Americans or anybody who holds dollars has to pay for that bailout because prices go up. That's what inflation is. It's a tax. It's the expansion of the money supply. And there would be a massive inflation tax if we had a lot of bank failures, which we will have. It's not a question of will banks fail. It's just a question of when. The banking system today is in worse shape than it was before it collapsed in 2008. It's not just the residential real estate. And I think residential real estate is worse now than it was back then, because back in 2008, when we had that crisis, the problem for the banks was that people were defaulting on their mortgages. And when they defaulted and the banks foreclosed, the collateral had lost value. That was the problem. Real estate prices went down, and so they were taking a hit on the foreclosures. And borrowers had an incentive to default, because why pay a mortgage? Your mortgage is $400,000 and your house is only worth $300,000. Why pay the mortgage? I'll just go rent something for less money. Well, today, people are not, mailing in the keys. They're staying in their homes. They're paying their mortgage. And that's the problem for the banks, because the banks now lose money on every mortgage they own. They would be better off if you defaulted. That way they can get out of jail. They can sell that mortgage. The housing prices haven't crashed. It's the value of the mortgages that have crashed because interest rates have gone up. So now the banks lose money on all the mortgages, not just the ones that default, but the ones that are being paid in full. And people are not leaving to rent because the rents have gone up, and their mortgage is not, because, it's fixed. Now, maybe their insurance costs have gone up, or their property taxes, and maybe they just don't pay their maintenance or some things, but they're paying their mortgages because they got them locked in at these low prices. But commercial real estate, which was not even a problem in 2008. In fact, when the Fed slashed interest rates in 2008, 2009 to prop up the economy, that really helped the value of commercial real estate, because commercial real estate prices went up as interest rates came down. But now commercial real estate is a massive disaster. Real estate prices have crashed. Commercial real estate prices are down 20, 30, 40, 50, 60% or more. You have office buildings that are empty or significantly empty. You have retail space that is empty. People are working from home. People are shopping from home. So you have all this space on the market. So rents are falling, and the landlords, they don't have 30-year fixed rate mortgages. Commercial real estate loans are shorter term. And so they are maturing, which is good for the lender in that they're not locked into a low rate. But what's happening is, as these loans are maturing, the borrowers are walking away. The commercial real estate lender borrowers, they don't want these properties. They'd rather just default, just like the homeowners did in 2008, because they're not worth anywhere near what they borrowed to buy them at. And so the banks are staring at huge losses on defaulting commercial real estate and huge losses on their residential real estate loans that are being paid. So the banks are a complete disaster, thanks to the Fed, thanks to years of artificially low interest rates and quantitative easing and government guarantees. The entire U.S. banking system is insolvent. The banks that people are taking their money out of right now, that's what's going on. I mean, it's happening. One of the reasons that these banks had to go to the Fed with their underwater paper was because their customers wanted their money back. They didn't want to leave their money at risk in these regional banks, so they went and withdrew it. But the banks didn't have it because they loaned it out. They loaned it out with 30-year mortgages. They owned mortgage-backed securities. They owned treasuries, which had lost a lot of value. So they had to take those bonds, which maybe were worth 70 cents on the dollar, give them to the Fed, get $1, so they can give that dollar to their customers, who then took that money and sent it to JP Morgan. They put it into a money market fund, loaned it to the government to get 5%, because the bank was paying nothing because they couldn't afford to. But now how are the banks going to repay the Fed the money that they already gave their customers? They don't have the money anymore, right? What are they going to give the Fed? They've got nothing. So obviously the Fed is going to extend the maturities of these so-called loans, but they're not really loans because the Fed is never getting repaid. So it's a new QE program in disguise. The Fed is going to pivot. That's the big pivot. It's not about when the Fed is going to cut rates, but when the Fed's going to go back to QE. I think that's coming this year. Even if they don't cut rates, I think they're going back to quantitative easing. The main reason that the Fed is going back to QE is because the alternative, while the correct thing to do, is just politically a non-starter, especially in an election year. We are running $1 trillion deficits, basically a quarter, even though the official national debt is a little under $2 trillion, which in and of itself is a huge number. If you just watch the rate of increase of the national debt itself, because that doesn't lie, there's no phony accounting, that's just the number. Every quarter, the debt is $1 trillion higher than it was at the beginning of the quarter. So the government is selling all these bonds. Over the course of 2024, over 10 trillion of treasuries matures. And now the government has to sell new treasuries to repay the maturing treasuries. So that's, 10 trillion worth of borrowing, 12 trillion worth of borrowing, plus the 4 trillion to finance current spending. Who's going to buy that debt? Once upon a time, the Fed was a big buyer, the biggest buyer of treasuries. Now the Fed is selling. Another big buyer that's not there are Social Security trust funds. Social Security used to be a big buyer of treasuries. Now it's a big seller of treasuries because up until a few years ago, the Social Security program took in more in taxes than it paid out in benefits. Now it's paying out more in benefits than it collects in taxes. So where's the money coming from to make sure the Social Security checks don't bounce? Well, the Social Security trust funds are liquidating their treasuries into the market. So the trust funds are selling treasuries. The Treasury is selling treasuries. The Fed is selling treasuries. You know who else is selling treasuries? The Japanese, the Saudis, the Chinese, the Russians. I mean, they probably sold all of theirs already. But who's buying these treasuries? And if there's no one buying them, the price is going to collapse and yields are going to explode. The Fed's not going to let that happen. The Fed's going to come in and be the buyer, but it can't do that without going back to quantitative easing. And that's what's going to happen sometime this year.